This is Umar Manzar from MoneyWiseSmart, and today is your lucky day. I have a very interesting video for you. If that isn't incentive enough, watch till the end and you can benefit from a free gift. Enjoy!
What if God were your investment manager? How has Warren Buffett fared as an investor? And what do we as mere mortals do as investors? So in this video, I will discuss some of the key investment lessons I have learned.
Guys, a lot of work goes behind the scenes in making these videos, and your help can go a long way. May I ask that you hit the like and subscribe button so that you continue to benefit from our top quality research?
Before we get started, a quick look at the disclaimer. None of the information presented over here is meant to be investment advice of any kind. This video is solely for educational purposes. So can you make a quick buck in the stock market? You have to understand that the results are unpredictable in the short term, no matter what the investment strategy. And long-term superior returns come at a cost. You need to be willing to accept disappointing performance numbers in some periods. The market self-adjusts. You need to respect that. That's just how it works. For example, if buying low PE stocks worked, everybody would do it. Eventually, low PE stocks would get too expensive and the strategy would stop working. Let's have a look at Warren Buffett's summary statistics over the years. These figures are absolutely impressive, especially when you look at the CAGR and the Sharpe ratio. He has been beating the market by a hefty margin. However, what we do tend to forget is that these are consolidated numbers. If you look at some of the largest drawdowns Warren Buffett has suffered, we might be surprised. He suffered a drawdown of minus 44.5% in 2007 and a drawdown of minus 43.8% in 98. What do we as investors do? Well, we can probably take a leaf out of Warren Buffett's book and stay grounded. I wanted to share with you what he had to say in the 1999 shareholder letter, where he was extremely critical of his own performance. He said that even Inspector Clouseau could find last year's guilty party, your chairman. Do you guys know who Inspector Clouseau is? He was this comical character who couldn't do anything. Let's have a look at this video and we'll come back to this presentation afterwards. Did you guys enjoy the video? Warren Buffett gave himself a D for capital allocation in 1999. So would you have had the foresight to stick with Berkshire Hathaway in 1999? If you did, you would have been handsomely rewarded, as the stock price has gone up more than 8 times since 99. What if you could perfectly predict stock winners? Sounds good, eh? Let me share an extraordinary article written by Wesley Gray from Alpha Architect, in which he illustrated how the best possible investment strategy would go through massive drawdowns in the short term. He basically calculated the 5-year look-ahead returns for all common stocks among the 500 largest firms in the main US markets. And the chart below shows these returns arranged in 10 deciles. The lowest decile generates a return of minus 15.3%, and the highest decile makes an impressive annual return of 29.4%. If someone had perfect information about the future returns, then you would buy only the best stocks in the market and produce an outstanding average annual return of 29.4% in the process. These godlike returns come at a cost. Guys, returns are not risk-free. So in this special portfolio, there are 10 different drawdowns of more than 20%, and the biggest drawdown is minus 75.9%. So you would have lost more than 3/4 of your portfolio between 1929 and 1932. And in the 2008 to 2009 financial crisis, the portfolio would lose as much as over 40%. What about a long-short portfolio? Leslie Gray further scrutinized the performance of a long-short strategy, meaning, what if this portfolio managed by God or a God-like portfolio manager was long the best decile and short the worst decile of stocks? This strategy could buy the best performing stocks and bet on the downside on the worst performing stocks. Simply as good as it gets. In this case, the annual return rises to above 46%. However, this portfolio would still have several big drawdowns of considerably more than 20% over the years. Think about that for a second. The numbers show that even the best possible investing strategy, one that makes spectacular gains in the long term, would have massive drawdowns from time to time, and it can significantly underperform the market in some years. Maybe this was a one-off flawed study. Maybe the author made a formula error somewhere. I can assure you that's not the case. Here are a couple of other resources you can refer to. If you read the book 100 Baggers, Stock That Return 100 to 1 and How to Find Them, you will understand how this works. The book basically covers the stocks that have delivered the biggest gains by multiplying by over 100 times over the long term. A single stock with these kind of returns can actually change your life financially. Article titled The Agony of High Returns by Morgan Housel looks at the biggest gainers in the market from 95 to 2015. And surprise, surprise, it reaches the same conclusion. If you want superior returns in the long term, then you need to be willing to tolerate enormous volatility in the short term. There is no way around it. What is the best strategy when it comes to investing, you might ask? Praise for impact in the short term. There are absolutely no guarantees that if a company is supposed to do well in the long term, will also do well in the short term. Stop watching the news and tracking stock movements on a daily basis. There is no get-rich-quick scheme here. For mere mortals to accumulate wealth over the long term, educating yourself about the businesses and patience are absolutely key. And this is where MoneyWiseSmart can help. You can click on the link below and access some of our free videos, just like that.
If you found this video useful, then I urge you to join our research platform. It's completely free, there are no hidden costs, and that's the place where we publish top quality research covering companies with the capability to compound in the long term. And that's also the place where we publish research discussing key investment concepts. So if you would like to increase your knowledge of investing, then you would surely benefit from joining that platform. The link is in the description section below. Guys, if you found this video useful, then don't forget to hit the like and subscribe button.